and truly, in these times, we're talking about payment more than we're talking about rate. I know that rates are out there all the time and they're like, oh my gosh, I saw this rate. That's awesome, but let's talk about your payment. I always, like with any contract that I get or any buyer that's looking at a home, if it's a low tax bill or anything like that, or if I'm doing new construction, I tell them where that payment is going to go.
Yeah.
Estimated, it's not 100%, but this is definitely close to where it's going to be. Come to us as a loan officer. We can provide options to get you qualified. So it's all about the power of getting qualified first. And then if you're not, coming up with a game plan on whether it's credit repair, we have rescore options. We have so many things, and we can actually educate you on what you need to do to get approved. So another piece of advice is just really looking for a good team. So when you're looking with a realtor, making sure they're educated on the area and they have a good team behind them, because really and truly we all work together. It's not one person. So, you know, it's a trifecta.
Welcome to the Homeowner Hookup,
where we break down everything you need to know about real estate.
Straightforward, practical, and always up to date.
We're your hosts, Megan Huey
And Sydney Ragusa.
Let's dive in. Hey, Sid.
Hi, Meg.
How's it going?
Oh, it's going great. How are you?
Good. So today we have a special guest, Kayla Goldstein.
Hey.
From Atlantic Trust Mortgage. She is here to talk to us about rates, what buyers and sellers want to know in today's market. Thanks for coming.
Yeah, thank you guys for having me. This is legit in here. I love it so much.
Awesome. Yeah. Shout out to Cody.
Shout out to Cody.
You did a great job.
All right. So today we're going to talk about rate updates. We're going to talk about mistakes buyers make when talking to lenders. We'll touch a little bit on the Fannie Mae, lowering the credit scores, down payment assistance, just kind of a plethora of what.
50-year mortgage that's up in the air right now.
Lord.
Oh,
Yeah. So we're going to be talking like this is a brand new person, knows nothing about the buying process. So let's start, I guess, first and foremost with the rate update. Where are we at
So rates today, conventionally, are probably in the low sixes. Can get to the high fives, depending on credit score. And then VA is in that mid, same as FHA, kind of that mid-5 range, depending.
Mid fives, that's pretty.
No, it's really good. Mid to high. It depends on the buyer, obviously. So I hate kind of shouting out rates.
Yeah.
Because there's so many factors that go into it. But I'll tell you, the last, few contracts I've gotten right now, it's been pretty easy to get them in a really great, sweet spot, whether they're using seller credits or whatever that is. So being creative that way, too, has been helpful to get them even lower.
Yeah. I feel like you are the queen of creativity.
Oh, my gosh. I love being creative with my buyers. All day, every day.
You're
It makes
so
it
good
exciting.
at that. Yeah. I feel like Kayla is the person you go to when you're like, I don't know how I'm going to get this approved, but she'll figure it out if she can.
Figure it out.
Yeah.
I call everyone and resolve the problem.
Yeah, you do. You do. Okay, I guess when we're talking about when people are coming to you, what are the things that they need to bring when they're looking to buy a house? If they're like, hey, Kayla, what documents do you need from me? Where do we start? Are you going to pull a hard pull first? Everyone wants to know that.
We're going to view, several things. So I know earlier we were going to talk about maybe pre-qual versus getting pre-approved. So we traditionally don't do pre-quals because that's just something you can do online where you can plug in your information and say, hey, this is what I have, this is what I make. And they're like, oh, you're qualified for this. And then you get this pre-qual letter. Well, for us, we're going to verify your income, your assets, how you're getting paid exactly, whether you're self-employed, W-2, or commission. So depending on that first conversation is kind of where I'm going to lean into what exactly I need because every buyer is so different. So, based on that general conversation before even doing an application, I would say, okay, up front, if you're self-employed, I'm going to need, bank statements, your tax returns for 2 years. And then if they're like, I don't have tax returns, then I'm like, okay, we're going to do a bank statement loan and here's what this looked like. So every conversation kind of leads differently.
Yeah.
But we're going to verify all of your documents ahead of time. So you're 100% approved when they go shopping with you guys and they feel completely confident that they'll get approved for whatever house they find.
What are some common things that might pop up where you're like, ooh, didn't know this, or they didn't disclose, or whatever it may be?
So randomly, I've had a couple files recently where, what is it called, where you can shop on Amazon and pay later? I keep forgetting that term.
Klarna or
Klarna or Afterpay.
Affirm? Is it
Yeah.
Affirm?
Affirm,
Stuff like that. So that sometimes doesn't show up on your credit report. And so like the underwriter is going to find it essentially. So I had a buyer recently that kind of came up and it was like a pretty hefty one. And her payment was like, over $500 a month.
Oh,
And so when your ratios are tight like that, being super upfront with your lender, like they're not going to tell you guys everything, but like when we're having that conversation, that's the time to be honest.
yeah.
Like, hey, I actually have this. Let me think about that and like tell us everything so we can say, oh, you know what, I really need to include that because this can affect your, your debt ratios. Being upfront is like the biggest thing because a lot of buyers, they just fill out the application, we verify everything that's on there, but they're not telling us anything extra. So when stuff like that comes up, it does get a little frustrating for all parties. So then again, we have to be creative and figure out how we're going to get that resolved. So then we're jumping through hoops. So it's better just to be honest, here's everything that I have. We will find certain things that they maybe have forgotten about, and that's fine. But those are the big things. So things that don't show up on your credit profile that you might have. I had a VA buyer that actually pays, some of his disability back to the VA for whatever reason. So he didn't disclose that. Child support, stuff like that. Like they'll just kind of breeze through the application, we'll verify it, and they'll say yes. And then they're like, oh gosh, I forgot,
Yeah.
stuff like that.
So how does child support affect? Is that considered a debt? Or?
It is. Yeah. If you're paying for it for 3 years preceding, we have to count it against you. And then we can't use it if you're not getting it for 3 years preceding. So
Okay.
it's dependent on, age of the child, that kind of thing too. And then also in the beginning of a divorce, if you haven't received 6 payments, we can't use it yet.
Right.
So there's several guidelines to that. So that's why we have these conversations so we can really fine tune everything ahead of time.
So it can be used as a debt, but it can't be used as income, right?
If you're paying, it's a debt.
Okay.
If you're receiving, it can be used as income depending on how long you've been receiving it and
Oh,
how long
interesting.
after.
Okay.
Yeah.
Very nice.
So what do we look at as far as down payments go for like a typical conventional loan for someone that's got average credit that you would be seeing today? Like what would you recommend that someone does for a down payment?
And what would you say is average credit?
Yeah.
Oh God. So average credit is like mid to low 6s, I guess. And then for that credits, so obviously first time home buyers, they're going to put 3% down. So that's traditionally what we're seeing. We also have, it really depends on the buyer. It's so complicated.
It is. It's like a magic
It
potion.
is. There's a magic potion based on their full history. We have so many programs. So for first-time homebuyers, what I'd see is, if they have 3%, do that. If they qualify for assistance, we have so many programs based on their scenario. So again, if you have a buyer that's like, you know what, I definitely need the assistance, make sure they do an application ahead of time because there's so many programs and we have to make sure they fall in the guidelines of qualifying for that program. Not everyone will always qualify. Sometimes you have to have reserves, a certain credit score. There's different factors to that. But we also have a really awesome program where they can put as low as 1% down and the lender will cover the 2%. And it's a true 2% they're getting and they don't have to pay back. So that's a great program too. So really depending on kind of when we're getting the application, what we're seeing as far as assets, their credit score, their income and all of that is kind of what leads us and guides us into what down payment makes sense for that buyer. Traditional, 20% down might not always be great too. I price between 15 and 20 depending on how cheap the MI is because if they have great credit, the MI might be like $28.
Yeah.
So saving that additional, 10,000 or whatever it may be and maybe applying it towards the rate buy down might be a better option. So it's really buyer to buyer. And that's what I'll keep saying kind of like through the day.
Throughout
Is
the thing.
Yeah. And MI is mortgage insurance.
mortgage insurance. So
Yeah.
if you're above 80% loan to value, which we'll talk about that when you're getting pre-approved, then you have mortgage insurance.
Yeah.
Okay.
I know you mentioned down payment assistance programs. What has been one that you're seeing a lot in Northeast Florida that people are using?
So we have an FHA one that's really great. So it's just better because the interest rate is kind of in that low 6 range and you get the 10,000, So really in our office, that's pretty much, we have, one lender that's what we're using, but I don't do a lot of down payment assistance outside of that.
So, and the down payment assistance, that's actually like a bond, right? That you have to pay back. And like that would be paid back.
Yeah, it's a
as
second lien.
second mortgage or something. Yeah.
Second lien.
Okay.
So that's the confusing part too, is that a lot of buyers are like, oh my gosh, I want this assistance. But then when you kind of chat with them through the program, they're like, oh, because most of them are going to want to refinance, especially now with where rates are kind of all over the place. So I always will walk them through that program. But I'll tell you, I've been doing this for, over 7 years now. And I've not done many down payment assistance because I'm educating. We always walk them through getting a gift over getting assistance.
Mhm.
I talk with agents about getting seller credits. We go through kind of what assets they have and if they can pull from their 401k and what that looks like ahead of time. Because if it's somebody that's like really rate cautious, then they might not want to do the down payment assistance because then, to refinance, they'd be paying that money back. So then they're paying for it anyways, essentially.
Right.
So that's the conversation that we have. Now, the people that truly need it, 100%. There
Yeah.
are people out there that definitely need it, but I like to make sure they are fully aware of what those terms are because I even get a lot of buyers today that call me and they're like, I had no idea how to pay this back.
Right.
And it's so frustrating because people just promote all this assistance and they're not educating their buyers.
Right.
on
It's
what
not
it looks
really,
like.
I mean, it quite frankly is assistance. It's not
It's not free money.
Right,
Yeah,
right.
It's not.
And I think, a lot of, especially young first time home buyers, like they don't
They're like,
realize
I qualify
that.
for assistance. And I'm like, okay, but do you have 3%?
Yeah. Yeah. And no, in your first conversation, so for instance, I've had a buyer come to me with a pre-approval letter already, right?
Yeah.
And then we start shopping, we're talking, and then they don't have the down payment. And I'm like, okay, well, how did you get pre-approved? Like, was this conversation
Right.
not you know what I mean? Like,
Yeah.
why are we getting to this point where we're shopping and we don't have any money to put down or any kind of idea where we're going to get it from?
Yeah.
Is that a conversation that you have up front with people? Like,
100%. We go
Yeah.
like my application process. I mean, it's very quick. We move very quickly, so I don't want it to sound daunting at all.
Mhm.
But we really dive into everything. So like they know exactly what they qualify for. We go over multiple programs to make sure it's best suited for them. But yeah, so we definitely go through details like that because again, you don't want them questioning it the entire time. And even when they're shopping with you guys, I'm like, please call me back if you love this house and it might be higher than where you are supposed to be. Let's kind of like rehash everything and figure it out. But yeah, in that beginning conversation, I'm diving in like
Yeah.
all the way
Yeah.
with them so they know 100% like what their options are and then we fine tune it.
I mean, it gives people the opportunity to purchase a house that may not have had the opportunity
Correct.
before. Like,
Yeah.
I mean, there are so many factors that go in with getting qualified and like
Yeah.
having that money. And even if your credit score qualifies, your income qualifies, like there are so many factors that like if you just need that assistance
Yeah.
and that's good for you, then like that's awesome. It's
Yeah.
awesome that program is available.
Yeah.
Why don't we get into debt to income ratio? Because I think people don't really understand that.
So debt to income, depending on the program,
Yeah.
honestly, depending on the program, credit score. So if you have a buyer that has like a 604
Mhm.
and they want to go FHA or VA, they're probably going to be like, normally we can go over 50% for FHA or VA. But depending on their credit history and if they have any lates or anything like that, the ratios are going to be a lot tighter.
Right.
Okay, so we're probably going to want to be around like a 45% back end ratio for them. And then there's other options too. We can do a manual underwrite, but they have to be within those tighter windows as well. So, traditionally we want to be right at, great credit. They can go, I've even got VA approved at like 57% debt ratio. So
Okay.
it really depends on the buyer's credit history and profile. But yeah, so typically FHA can be anywhere between that 50-ish range and higher. If their credit scores are lower, it's going to be lower than that, obviously. And then conventional, you're 50% or lower.
And when we're talking that 50%, are we talking about payments per month that add up to a certain amount?
So
And
we're
then
talking,
how much you make?
Yeah.
and-
So
okay.
we're looking at your new payment, your projected new payment for the new house. We're looking at if you have a house, your current payment, or, after what that rent is that you're receiving, we're applying that. And then we're looking at all your debts, and that's all calculating your debt to income ratio.
Gotcha. Okay. Yeah, that's a big one. I think for a lot of people, they don't realize those payments add up each month.
Oh, yeah.
And it's not
100%.
necessarily the overall number, it's that number of for your payments each month.
So basically, it's like if you have a credit card, we're looking at the actual payment. So basically, if it's like, you have a Capital One, it's a $300 payment. We're taking that $300 and that's what we're using.
Yeah.
And then the same for every credit card.
Okay.
And then like Amex, if you don't have to pay off the full balance, we use like a percentage. So there's so many factors that go into it.
Yeah.
But we're taking the overall debt ratio, and traditionally conventional is 50% or lower. And then FHA is in that like 50, but we can go higher than 50 depending, and VA same based on your credit score.
Okay.
So you mean it really just depends buyer to buyer?
It's buyer to buyer, you guys. Yeah. That's why you definitely
You
want to
don't
get
say.
approved because, it's a guessing game, honestly.
It really
And
is.
every buyer is so different. Again, I can get one approved at 57%, which is like making magic happen. And then another one's like 45%, based on their full history,
Right.
So it just really depends.
Credit is so important.
Yes.
Like this should be taught in like middle
School.
school.
No,
It really
100%.
should.
I
Like,
agree.
It's crazy to me how many people get out into the real world and don't understand it. And then, not crazy, because I guess I didn't even really, my parents have like perfect credit scores, and I didn't really understand credit going out into the real world when I was younger, graduated college, didn't even realize like, oh, student loans, this, that, and the other. Like,
Right. You're just like, sign me up. You
Yeah.
have no idea.
Yeah. Yeah.
But it's crazy. Like, I think it's so important. And I teach my kids too. Like, all of us, I'm sure, are all teaching our kids. But it really should be a class because they're so like blindsided when they're first time home buyers too. Like, they have no idea what they've done.
Oh my gosh, I know. Save as much money as you can.
100%.
How long does a typical mortgage process take right now, and what can slow it down?
I always say 30 days or less, but we get files closed very quickly. So I've gotten some closed in a week. It really just depends. If an agent comes to me and says, hey, these buyers have to move within 15 days, like, can you make that happen? I'm like, yeah, we can make it happen, but the buyers have to be proactive with us too. So a lot of times what can delay closings is, the buyer's not proactive with responding to emails or getting us documents or signing a loan package. And then third party stuff. So we can wait on insurance, like I have one right now where there's a roof issue. So we had to wait to get that repaired, and insurance can't do anything until the roof is completed. So now we're leading into closing. So stuff like that. Little things come up all the time. That's why you want to make sure that you're working with someone that, can get a hold of all the people they're working with, because it does take a team. But yeah, if you're trying to close quickly, proactive, helps.
Making sure your
Making
ducks are in a
sure.
row.
Yeah.
and- yeah.
Getting
that's-
documents within like
Correct.
5 minutes of you asking for
Right.
them.
But
right?
that should all be in the pre-approval process too. So really that part shouldn't delay, but it's more of like through the process if we need updated documents or the underwriter has a question, just really being responsive. But 30 days or less, comfortably 15 to 20, just depending on the type of property and the buyer.
And also working with, I know you touched upon bank statement loans. And let's talk about like business owners, for instance. I know like you're well versed in that,
Yep.
but I know when me and my husband went to go buy our house, we were buying D.R. Horton and builders. They had no idea how to work with people who are business owners, because both of us were,
It's so
or
wild.
are. And so it was like going through bank statements, going through this, my husband used to be a loan officer, so luckily he was helping like walk them through the process.
Yeah.
But he's like, I get like 2 of these a year, maybe. You know what I
Right.
mean? Whereas you're much well versed on it because you see it all the time.
Yeah.
What are ways that you could tell business owners or 1099s how to kind of prep themselves for the home buying process?
Yeah, so tax returns are obviously a thing.
Mhm.
So making sure you're staying on top of your tax returns. However, there's that case where they maybe haven't been able to do them for whatever reason. So then just having your bank statements available, because that is like such a great option. I've been doing bank statement loans, like honestly in the last 6 months, so much more now than I ever have before. It's a really creative way for business owners to kind of get around, if their taxes, if they don't have them. So 12 months of bank statements, depending, sometimes 24 months of bank statements. And then what happens is we basically just upload that to the lender and they review the deposits and everything and they tell us what income can be used. We can calculate it too, but they just do it so quickly.
Yeah.
But it's a great program. Now, the difference is that a non-QM loan, so it's non-traditional financing. So the interest rate is going to be slightly higher. You might be paying points, to get into that mid to high 6 range.
Yeah.
But the loan process is just the same. So it's 30 days or less.
Yeah.
It's just bank statements. So.
Because a lot of business owners, obviously, tax write-offs are a thing. You don't want to have to pay a ton in your taxes, so then you have to claim less income,
Right.
which then makes it hard for you to qualify for certain loans.
100%.
So you have to get creative as a
Yeah.
business owner and you guys working with business owners. So it's definitely important to have somebody who knows how to work that
There's
process.
so many things. Bank statements probably one of the it's not the easiest, but it's just one that I've been doing a lot. But we have so many other loan programs too, like asset depletion, depending on assets. I mean, there's so many things for business owners. But bank statement's a great option. So anyone that is self-employed, it's a super easy process.
Yes, and deposit your money into a
Deposit it.
bank.
Oh my God, please. Yeah.
It's
Yeah,
the
there's-
cash under the mattress thing
That
that
doesn't work.
yeah, it doesn't work.
Yeah. I mean, there's some buyers we just can't help. But yes, make sure you're doing your deposits and it's not large lumps of cash that are just being deposited because that can get kind of wonky and we will back it out and not be able to use it.
Yeah,
A
yeah,
couple
that's
years
true.
ago, talking about cash under the mattress, a couple years ago, I was coaching an agent and she had her first cash transaction. And I was like, that's awesome. Da, da, da. She's like, yeah, we close in 10 days. I was like, okay, great. And she was like, but the title company like needs them to wire the money. And I was like, okay, it's cash. Yeah. And she was like, well, they just wanted to literally bring the cash, like $300,000 in cash. And I was like,
Like in briefcases?
yeah, basically like in like a sack that's got a money sign on it. I'm like,
Amazing.
I was like, well, I don't think they
can do
can do
that.
that. And she was like, well, they don't keep their money in banks.
Well,
So you just keep all of your money like literally
I
underneath
mean,
the
some
mattress.
people do. Yeah,
They do. They
That
like
is
are
wild.
scared.
And I was just,
Don't
I
trust
just
the
said like,
government.
I don't think they can do that. And the title company said that no, they
They
couldn't.
couldn't.
And they had to deposit it and all these things. And they ended up not getting the house. And I was like, oh, so sorry.
Yeah,
Yeah.
it's crazy.
Mm.
I mean, there are
It is
people like that.
Deposit your
Yeah.
money.
they don't trust the banks. You know, it is what it is.
That's
but
okay. Just
maybe
deposit
you
the
can't-
amount that you need.
Yeah.
Like wire it.
Yeah, yeah.
Yeah.
What do you say when people say buy now and refinance later? Or do you say wait for the rates to drop? Or do you say whenever's the right time for you?
I always say buy. It makes sense to buy now. I
Mhm.
mean, you're like, it's such a cheesy saying. I think everybody says it. Like you're
Yeah.
dating the rate.
Yeah.
Okay. Because we're obviously all going to refinance in these times in the last few years. So if you're waiting on like the magic number, it's not going to be ever perfect for you. So talking with a loan officer that can be creative for you for your scenario. I mean, really and truly, in these times, we're talking about payment more than we're talking about rate. I know that rates are out there all the time and they're like, oh my gosh, I saw this rate. That's awesome. But let's talk about your payment,
Yeah.
you know, because if you really break it down for them like that, then it's not as scary. And they're like, okay, great. And then I can wait to refinance. But I think do it now if it makes sense for you financially, not just thinking about the interest rates, because
Yeah.
you can always refinance. And if it makes sense, and if you're working with a good loan officer that educates you on that, and when it does make sense, then they feel more comfortable kind of going into it.
Yeah, absolutely.
Mhm.
I definitely think it's like case by case, kind of like this
Correct.
entire situation or
Yeah.
the whole loan process is.
Right.
It's like if you can afford it now and you want to do it, go for it. And if best case scenario, rates drop, you can refinance later.
Right.
Worst case scenario, you're at where you're at and you can afford it.
You know, the best thing recently is we're talking a lot about, okay, well, here's where the current interest rate is. And they tell me like where they want their rate. You know, everyone wants the specific rate.
Yeah.
So I break down the payment and give them like 3 or 4 options and show them the difference. And then at the end of the day, they realize it's really not that big of a difference. And they're like, oh my gosh, I'm so shocked. And I'm like, yeah. So like, you're good. You can move forward with this. And then, you know, if it drops a full point, that's when it makes a really big difference for you. But if
Yeah.
we're talking about a quarter or something so small,
Mhm.
it really makes no sense to
wait.
Yeah.
Right.
Right. Because it's such a small payment difference.
Mhm.
And then again, like using seller credits, there's so many sellers giving seller concessions right now. That's a creative way too. So, I mean,
Yeah.
if you're using other people's money, it makes sense to buy it down. But if it's your money, then it might not make sense. So it's a conversation for sure.
Yeah, that's one of those where it's kind of like dependent on the person and the
It
situation, the
is.
loan, if it makes sense to buy the rate down
Right.
or use concessions or whatever, however you want to use that money.
Right. Yep. And if they, you know, have a house or like, let's say a condo and we have to be creative because the HOA came in higher, you know, when they found it and they love it so much. They love it. And they're like, oh my gosh, Kayla, I love it so much. But the HOA is this and their debt ratio is too tight. In that case, we would have to talk about rate and like maybe buying it down and how far we need to buy it down to where they qualify for this home they love. And does that make sense? And then talking with the agent on can we get the seller credit if they don't have the funds? So, you know, there's several things, but if you love the home, the rate is something so silly to wait on, you know, because there's no crystal ball telling us when it's going to happen. I mean, I've been saying consistent 5s for the last 3 years, we've been waiting on a consistent pattern of fives.
Yeah.
And like,
Yeah.
it goes down and then we're kind of like going right back up. So there's no, if you're waiting on that perfect number, it's not going to happen. It might happen for like a week in time and then you waited and then you missed the opportunity. So
Yeah, I feel like it's like just hovering for a while, right around
Yeah.
6, and it really hasn't gone down too much.
no, I mean, for a couple weeks, I think a few weeks, we were like in that 575, 5875.
Mhm.
And now like 599 is exciting,
Did you see a big increase right around like the 575?
Not really. I mean, it kind of stayed consistent.
Because
Like-
people are like, oh, wait, we're going to wait for it to go even lower now.
No, literally. Literally. That's
Yeah.
what people say. And it's so funny to me. And that's why I just like kind of stopped talking about interest rate so much. And it's like payment. Like the payment is
Yeah.
what you need to focus on. Because if you told me 2,300 and we're at like 2,100, you're good. The
Yeah.
rate has no bearing on you. And when you refinance, it's even better. But yeah, I mean, when they were in the fives, I did have some people that were looking to refinance out of like an ARM or something like that. They're like,
Mm.
oh, I'm going to wait a little longer. And I'm like, okay, good for you. And then they went back up. So it's, and they waited 3 weeks and then I'm like, sorry.
Yeah.
So if it happens, you need to do it then. And then if rates are at 6.25, rates are at 6.25, you love the house, do it and refinance,
Mm-hmm.
All right, Kayla, what advice do you give buyers who are nervous about monthly payments changing with taxes, insurance, and HOA fees?
Yeah, so this is a really good one. So when we get a buyer, some of them go new construction, some of them go resale. So really educating the buyer on like what can change within your payment and why is really big. Because a lot of times I've had some buyers right now, like the tax bill is super low. So then I'm educating them on, hey, why the tax bill is super low right now, but it's going to get reassessed. And some loan officers don't do that for them. So then the next year they're shocked and their payment went up like $300 and like, oh my gosh, what happened? But yeah, insurance premiums can change yearly. Taxes definitely can change. If you homestead it, it limits it, the percentage that it can go up every year. So definitely homestead if it's a primary. But if you're buying new construction too, definitely if you're working with a real estate agent, make sure that agent is asking, the agent that's working with the builder where the taxes are, if they're just based on the land this year and where they think they'll projected to go. Because I've seen a lot of builders giving these low ball payments and then I'm comparing them and showing them like, oh gosh, this is really low,
Yeah.
temporarily, but this is really where it's going to go because a lot of them aren't explaining that. So
Yeah, brace
That-
yourself in 6 months for when the taxes are reassessed,
That
not just
is
on land value.
correct. And that's like payment shock. Like, oh my gosh, then they're freaking out. And then some people can't afford that. Like affordability goes out the door. So I always like with any contract that I get or any buyer that's looking at a home, if it's a low tax bill or anything like that, or if I'm doing new construction, I tell them where that payment is going to go.
Yeah.
Estimated, it's not 100%, but this is definitely close to where it's going to be. And I think that's a very important piece. So if your loan officer is not doing that, then that's definitely a question as a buyer that I would ask, like, hey, tell me about the taxes. We're not experts on insurance, so maybe they can get on the phone with their insurance person that they select. Those are the things that can change and it's very important, can definitely affect you.
Yeah, absolutely. I know I was the agent on our own transaction and I was putting away an additional like $500
Yeah.
every time because I was like, I know it's going to hit me, and because I was new construction. And sure enough, it did. And
Mhm.
luckily, I had the money there to go ahead and just pay it. But I mean, our payment jumped, I think it was like $700 a month.
It's crazy.
Yeah.
What's wild to me is I purchased new construction too, and they went ahead, like when I purchased, they went ahead and put it to where it was going to be the next year and like started putting reserves away into my escrow account, like for me, for the payments,
Mhm.
even though it was based on unimproved versus improved, which
Yeah.
unimproved is when there's not a building on the land.
Yeah, it's
Improved
just
is when
the
you have a structure on the land.
Yep. And some of our lenders do that too.
Right. And so, but then I have represented since I purchased my house, well over 60 people just in this one single builder alone. And they did not do that. I think maybe a year after I purchased, they stopped putting it into escrow for that difference in payment. And I'm like, why would they do that? But I guess
Yeah.
it's because like affordability, like they were
Right.
kind of conning these
Trying to
people
get 'em in
Buying
there.
it.
into these like low payments. And like
Yeah.
one of them was one of my best friends, and we were like looking, and I'm like, we were like at the closing table and they're like, no. And I'm like, you need to start putting away like an extra like $400 or $500 a month
Yeah,
for your monthly
absolutely.
payment.
And again, that's
Yeah.
why, you definitely want a realtor that understands that,
Yeah.
Yeah.
and can break that down for you, especially if you're going new construction, having someone there to look at that because they're slick sometimes,
Oh,
it's
yeah.
crazy.
That's also important to make sure you have a real estate agent with you when you're working with
Oh,
builders.
100%. Yeah.
Yeah, definitely.
Yeah.
All right, so let's switch over to sellers now.
Okay.
So, like from a seller's standpoint, how can you tell if a buyer's financing is solid?
So,
Now, I feel like that's more real estate agent, but yeah,
maybe it's
what
real
would you
estate agent, but I mean, it would be a generic letter.
Mhm.
Pre-approval letter is going to be something from, maybe a local bank or a local lender, and you can tell that they've verified income and assets by the pre-approval letter. And then also, a lot of times when my buyers are submitting offers, I definitely call the listing agent. So I think as a loan officer, having a conversation with the listing agent to letting them know everything you've done up front sets that buyer up for success, obviously,
Yeah.
with their offer. So I'm always like super upfront and forward about calling the listing agents as well.
We're
Yeah.
pretty listing heavy, and I love it when lenders call us when we get an offer. Like, hey, we're
Yeah.
such and such lender. We want to like call you and go over this with you. Like, oh, thank you.
Yeah, I feel like if it's a local lender or a local bank, it makes me more comfortable. If it's one
Absolutely.
of those, like, I don't want to say the names of them, but
Yeah.
A
just-
national, like a little
National lender.
more, yeah.
You can tell the generic letters too. Like you can obviously tell if they just went on there and like applied
Yeah.
or, a generic letter. It's very different. But obviously somebody that you can get a hold of is obviously better. So
Oh
it
my
goes
gosh,
a long way
yes.
being able to talk to like the loan officer.
Yeah, I want a cell
Yeah.
phone number, not a call center number.
yeah, I do not want a call center number.
Yeah.
So, does the type of loan, FHA, VA, or conventional, make a difference on how smoothly the loan will go?
So, I mean, conventional is obviously like straightforward. So, with some of the government programs, there might be different, guidelines as far as, inspections and stuff like that. And then WDO, there's just different things they would look at. But as far as like appraisals, I get a lot of agents that call me. They're like, oh my gosh, it's FHA. Why? And I'm like, it's not going to have any bearing on your appraisal, like the value.
Yeah.
It might be in lieu of repairs based on that program. But, financing is pretty across the board, for all the programs, and then working with the right lender, making sure they know all the guidelines for every program too. So if something does come up with an FHA loan, we kind of know how to work through that. So
Yeah.
no, I mean, you should be able to close every loan. There's hiccups with any loan. So I think putting that stigma on government over conventional is really silly. There might be a couple of additional inspections and stuff like that.
What is it that you look for when people are looking to make investments as opposed to the primary?
So we're looking for down payment. They have to have solid assets.
Mm-hmm.
Really and truly, it's the down payment and a credit score that we're like looking at. And then just kind of what type of property it is, so we can guarantee that it's 20% versus 25% that's required because different properties might require 25%.
What would be an example of that?
So like a triplex maybe would require 25%, something like that. But single family is pretty straightforward. So you can do 20%.
What about investment versus second home?
So second home, you can do 10% down.
Aren't there requirements on like distance from your primary residence?
Yep, you have to be, I think it's over 60 miles, something like that. So yeah, if it's a second home, but we can be creative there too. So a lot of people during COVID were moving here and their jobs weren't lined up, but they weren't quite remote. So you can do it as a second home, 10% down. And then once they get a job here, they could refinance and make it their primary. There's several things you can do, but yeah, 10% for second homes, investment properties, typically 20% or more depending on the property.
Okay.
So I have a question for you.
Sure.
We kind of talked about like creative financing a little bit. So I know that I have gotten a lot of questions from friends and from everybody about creative financing for like triplexes and quadplexes. And like on Instagram, you see a lot of like house hacking, right? And creative financing to get these quadplexes while still making income on the properties.
So
What are your thoughts?
right. So the question for me always is are you going to be living in one of the units? Because if you're living in one of the units, you can do FHA, 3.5% down, and then use the projected rent basically to cover the cost of your mortgage payment. So that's really the question, because if it's a primary, it's completely different than if it's an investment for those properties.
Okay.
Okay.
So, I mean, that is like a house hack. Like, if you wanted to have some investment properties, you just have to live in one of the units, and then you can use an FHA 3.5% down versus an investment loan of 20 to 25%.
Sure. And a lot of college kids are doing that because it just makes sense. Like their first property is, duplex, triplex, because they're like, it makes sense, to do that because they're going to do FHA traditionally regardless because it's a lower interest rate, So yeah, that's a great, I guess, program hack.
Yeah.
House hack.
LSAC.
I was going to ask about rental income. So using rental income in order to qualify in buying another property.
So yeah, rental income, we can use up to 75% of
Okay.
that. If you own the property, for a year or longer, we're looking at your tax returns to calculate that income based on, your write-offs and all that. It's a pretty easy calculation, but yes. So rental income is fun and we can do it. It does get tricky if you have several properties, but we're just using your tax returns
Okay.
in that case.
Gotcha.
So how does an appraisal impact the deal right now, and what can sellers do if it comes in low?
So there's only a few options.
Right.
I mean, traditionally, if you're putting like 20% down or more, it sometimes might not even affect it depending on how low the appraisal came in. But really and truly, you can renegotiate, meet in the middle.
Try to find more comps.
A buyer would cover the gaps. Yeah, you can challenge the appraisal.
Yeah.
So we've done that several times too. And I've seen some come up, depending on the comps. But if we're doing that, there's, a form that you would have to fill out and then we'd upload it and then they would review it. So it kind of is taken out of your hands after that point. But there's several things. But really and truly, I haven't seen a lot of appraisals come in low recently.
Oh yeah, they're trying to get the market moving.
Yeah. So
They're
I
trying
haven't
to find
really
anything.
seen much of that. And if anything, it's like super, like $5,000 or something. It's been like super minimal where it's not really affecting much. But yeah, there's several things. I mean, it's really just having a conversation with the buyer and the agent, as a team and saying, hey, here's the options, and then you guys approaching the sellers and having that conversation.
I mean, if you could give any piece of advice to a buyer in this market, what would be?
Really and truly, asking the right questions. So my recommendation is getting with your agent and saying, hey, I really, don't know anything about this. Can you tell me general questions to ask my lender, to kind of give them a guide? Because if you're working with the right loan officer, they'll ask the questions anyways, but some of us don't do that. So I think really educating them on the important things they might need to know when they're getting approved. And I also just think getting approved now. So if you're somebody that's like looking in spring and we're now in the fall, November, December, it's not too early. I think kind of having an insight on where you are ahead of time early on really sets you up for success as far as a game plan with you guys on your end. And as a lender, I mean, pulling your credit, it's good for 90 days or so. So it's just a repull and kind of having an updated conversation on if anything's changed. So it's super simple after that. But that way, you know exactly where you stand going into the spring or going into the next year. A lot of people come to us and they're like, oh, I don't want to pull my credit yet. I just want to wait. I'm waiting. I'm not doing anything for 60 days. Well, okay, that's great. But properties come and go so quickly still in this wild market, the ones that go really fast, but it's better to get approved now than to wait till very last minute.
And how long can you lock in your rate for?
Gosh, we have 6 months. I mean, it really depends on the buyer. New construction, there's options over 6 months, 9 months. It really depends. But, we traditionally are doing a 30-day lock. And we can, if rates do drop, there's several things we can do, especially as a broker, because I work with 30 national lenders. So, if we see a big enough drop, there's options for that buyer. But yeah, I recommend always locking in too. So locking in and getting approved as far in advance as you can.
I always worry when people don't want to get their credit pulled. I understand they don't want too many hard pulls, but when you are not willing to get it pulled, it a little bit, that worries me because I'm like, oh, do you know something that you're not telling me, or like what's going on here?
I mean, a lot of times that's maybe the case.
Yeah.
And they're like, oh, let me just wait. But really and truly, it's a few points.
It's not drastic.
Not super drastic depending on your credit.
Yeah.
The people that are worried about it are the ones, that need to do it.
Yeah.
That way we can educate them. There's so many things that we can do with you too. So that's the thing too, is when you come to us as a loan officer, we can provide options to get you qualified. So it's all about the power of getting qualified first. And then if you're not, coming up with a game plan on whether it's credit repair, we have rescore options. We have so many things, and we can actually educate you on what you need to do to get approved so then you guys can shop with them. So I think people are scared because they don't want people to see them like fail. But as a loan officer, that's our job, is to, if you are failing right now in whatever situation you're in, to getting you to that point if it takes a year,
Yeah, right now would be a perfect time to talk to you.
Right.
And be like, hey, I want to buy within the next year. This is where I'm at right now. What improvements do I need to make? Who do I need to get with to get my credit repaired? Because sometimes it's as simple as like getting off of a credit card.
Correct.
Right? Like
Yeah.
something very simple. or paying something down or whatever it may be. But you don't know until you know.
Yeah.
And you don't want to get in the situation where you're like ready to buy, you pull your credit and it's like, oh, you got to do work. It's going to take you some time. So,
Yeah. No, get pre-approved, guys. Have a conversation.
yeah, definitely. Well, we appreciate you coming on the show today.
Thank you. I hope
Thank
it
you.
helped.
Yes,
It
it
did.
did. It's
Okay.
super informative. Anything else you want to talk about before you sign off?
So another piece of advice is just really looking for a good team. So when you're looking with a realtor, making sure they're educated on the area and they have a good team behind them, because really and truly we all work together. It's not one person. So,
Yeah.
you know, it's a trifecta. So if you're having a conversation, they don't have any local connections, that's a big red flag. You definitely want them to kind of know in every area of the pre-approval and buying process, you know, having a team there for them. So I think that's really important.
Definitely.
Love that. Well, thank you, Kayla. We appreciate
Thank you
it.
guys.
Yay. We loved having you.
Yes, thanks for
All
having
your
me.
hand motions and all. We love it. Poor Kayla
Everything.
is over here in like hand motion jail. Sydney's over here smacking her hand.
Thank you.
So the next time we have Kayla on, I will be bringing a straight jacket. Not because she's crazy, but because she moves a lot.
I do. It's wild. Anyways.
All right. Thank you so much. We
Yes.
love you.
Love you too.
Kayla.
Thank
Love
you, guys.
All right. Bye, guys.
Bye.